Just a disclaimer before I start. This is not financial advice. It's only for education purpose only. So please do your own research before you make any decisions.
All right. Hi, everybody. My name is Richard.lesperance. I go by the name of my man, Richard. Welcome to A Better Lifestyle. Today, I have the pleasure to have Tom Suvansri. So, welcome, Tom, to the podcast.
Richard, thanks for having me.
My pleasure. My pleasure. So, who is Tom Suvansri?
Oh, that's a complex question, Richard. Um, but what I like to share with people these days is I'm a refugee from the corporate America world. I spent a couple decades in corporate America thinking that that was the life I was supposed to lead. As I got into it after 2 decades, I was eventually able to extract myself from it to now pursue what I would consider a much more passionate part of my life, where I get to help people gain more control over their wealth and help them live the life they really want to live. So I really have a fortune to be able to go do that with my life now.
Okay. So, today we're going to talk about wealth building. So, with everything that's going on, like inflation, the cost of living, like it's everywhere. So, I think it's pretty important for people to have to be mindful and have financial literacy if they wanna have a little bit more in their life. So we're gonna talk about life insurance. Life insurance is a product that people could use to build wealth. I know it's not really popular. Not too many people know about it. I know you know about it. So we'll talk about that. So talk to us about that. Like, how can people build wealth with life insurance, like the different products and all that?
Yeah, and it is one of those topics I think people don't love to talk about because it's maybe connected to death and brings up mortality. And in my world, when I think about it, it is a piece of the puzzle, and it's part of the foundation, right? When we think about financial sort of wealth, I kind of almost equate it to like a house, right? You're building a house, and the strength of it is starts at the foundation. And so, what does that mean? Well, us here, we're on this podcast together, living our lives, and we are our biggest asset, right? To generate wealth and create income, create businesses. And so the first order of business is to protect our biggest asset. And that comes with life insurance because we unfortunately don't know when we leave this earth. Unfortunately, if we knew that, life would be pretty easy to plan, right? For especially around finances. So using that as a sort of a starting point, it's to protect our well-being and certainly for ourselves and our families, a means to protect for something we cannot 100% control, right? So that is part of the foundation. The second piece of that is really about, which I think this is pretty basic, is we have to store money. We have to save money. It's not the sexiest thing in the world, but it's a place we have to make more than we spend, which is difficult in this day and age, right? With things costing crazy amounts, people can barely get by, and you see it now, which is an awful sort of thing that's happened in this economy. But we still need to save money to one, protect us for things we can't control, like emergencies, but more importantly, to use that wealth to take advantage of opportunities that come, whether in business or investments, not sure, but having capital ready to deploy when available, when opportunities come. And so having that sort of as a foundational piece, life insurance can play that role for a long periods of time, well before everyone was doing the stock market. People were storing money in life insurance. That's where people saved money. It wasn't banks because banks were dangerous, right? They would fall apart and people would lose lots of money storing money in banks because they were taking a lot of risk. And so people used to do that in life insurance. But given the nature of how everything's evolved in our economy, the stock market where people invest, people have moved away from it through certainly clever marketing and sort of positioning of other assets. But to me, it's a great place to protect families and then use it to store wealth that doesn't lose, right? And then use it to perpetuate other wealth building sort of things like investments, business, real estate, you name it. It doesn't really matter, right? But it's the foundational piece.
Okay, talk to us about the mechanics of how can someone use the product? Because here, me, I'm in Canada. I know there's
Yeah.
different companies. Like if you take a whole life, you pay for certain years, maybe 20 years, and then the wealth accumulates to the cash value. So talk to us about that.
Yeah. So the it's a really great way because if you compare it to what most people get accustomed to is term insurance, which is for a certain amount of time. And it still has a good value because it's just like you're protecting your house, right? You don't your house burns down, you have insurance. Well, term insurance works similar that you pay insurance, it's cheaper, but there's no wealth building being created, right? It's just for protection only and it has value. On the flip side, is things like whole life, right? And we use whole life because it's stable, right? It's you're investing using money, putting money into something that does not lose, and you using it as a storage. Basically, what it equates to is you have a large death benefit that can bring wealth to your family if something bad happens, but you're paying a little bit amount of that over time. And that what that does is build equity, which is called cash value, right? Just like if you had a house, you're paying into it and it's building equity in your house. So if you use that as sort of a comparison, your death benefit is this large amount. You're paying into this over time. And once you start building it, you have access to that cash to deploy. Now, in most cases, well, if you have a house, you have to borrow against it, right? Unless you sell that house, right? The concept of a home equity line. Well, there's a similar feature within life insurance, whole life insurance, where they let you borrow their money and use your cash as collateral because they know that you're good for it. We're eventually going to leave this earth, right? So it's the safest thing that they can do is let us borrow their money while our money sits there continuously growing in the background, right? Saving and it's not being used. We use their money to go invest wherever we want to deploy it, and we now can control the capital to invest in businesses, real estate, stock market, you name it, your choice. But we're using a controlled sort of financing arm to invest. And now we can control the terms of it, which is very different than borrowing from a bank. If we borrow from a bank, whose terms do we have to adhere to? Theirs, right? They have the control. They can seize our properties. They can dictate the terms, interest rates. And so from there, this is a way to control the financing piece of your wealth that you can deploy for other purposes.
Okay, like I was saying, here in Canada, we have different plans depending on which company
Yeah.
you use. Can you use in the States, you guys, can you, someone say, let's say they take a policy for 20 years and they build up that cash value, and then at 20 years later, they could withdraw that money. Can you talk to us about that? Is it possible?
Yeah. Absolutely. Yeah. And certainly what I would encourage folks is when we design them, and we're using large mutual insurance companies. So those are private. So like they're not public companies on the stock market. So as the insured members, we're kind of like partners with them. We own a piece of that company. It's a private organization. And I don't know if you have it in Canada, like community banks work the same way. We are kind of part owners in the company, so we benefit from their profitability. So as we're building up cash, I certainly wouldn't want to wait to 20 years, but along the way, you can use it by borrowing against it. You're not actually using the cash. You're using their money and you ask for it and they give it to you. And they don't care where you deploy it, right? So in that case, while you're building up cash over time and it will get better as things wear on, you can just ask for a loan and they give it to you. And then you pay it back on your time frame, which is the key because you have to have discipline. Just like using any credit, whether from banks, credit cards, where you have to be disciplined because you have to pay that back eventually, right? You should, right? To be an honest banker. Now, down the road, as people use this for retirement, there are means that you can actually just withdraw all the money you put into it first. Withdraw it first because you just contributed, say, $100. I can withdraw that first. Now, with no taxes because it was my money to begin with, and I use it for whatever I want. Now, if there's a gain in there, and there should be at that point, that has all been tax deferred. And the way to access gains with anything, whether it's real estate, stock market, the way you access it without taxes is to use it as collateral to get someone else's money. And that's what you do. You borrow against it to access that money tax-free, right? And then eventually down the road, when you pass, your death benefit will pay for all your debt, right? Outstanding. But you have to be careful to not over leverage. Just like in our world today, our governments are over leveraged. Unfortunately, households are over leveraged. You can't do that, right? You have to be responsible. So this requires a little bit of discipline.
So for people who don't know, so you're saying people could use that vehicle for having extra cash for retirement, right?
Yes, absolutely. I wouldn't say it would be your main source of funds, but similar in nature, like if you treat it like a banking type environment, that you're using that for, cash infusions you need to have, right? For things that maybe you want to take an extra trip or you want to fund your kids', first purchase at a home, whatever. You can use it as kind of a cash source to balance your other income streams, whether it be pensions or annuities or, withdrawals from investments. So you can use it as a supplemental source for retirement. I would not sort of position it as like your main retirement income source. It's just not built that way.
What is the average return on for that?
Yeah, so it's if you equate it to the safe environment and a cash alternative, is certainly when we design them, we're more cash heavy. It could earn in a range of say 3.5 to 5% tax, but remember, it's also not taxed, right? So you think about it from a storage of wealth that doesn't lose. It's a pretty good risk adjusted asset for that purpose, right? It's not doesn't lose, and you have access to that liquidity on top of the death benefit. So, we use that's why the use of it for other purposes to go invest and using it as a financing source really adds the power to it, right? Because if you just let it sit there, it's okay, but it's not going to earn massive returns by itself. That's not its purpose. It's there to protect and store wealth, store dollars, right? To then deploy. So it's not, I wouldn't equate it. We usually say this in life insurance. I don't even call it an investment because investment comes with risk, right? And we're hoping for more returns from those, right? Whether it's stock market, real estate, etc. This is where we just store money. And most people, I don't know what you're getting in your banks these days. It's better than it used to be, but sometimes it's almost negative. You're basically losing money, storing money in banks.
So you're saying for the withdrawal, it's tax free, right? It's not taxed when it's time to withdraw.
Right. So when the way to ensure that it's not a taxable event, you can withdraw everything you put into it first. You're basically taking back what you put in. So it makes sense. It shouldn't be taxable. It was my money to begin with, right? But when you build up the gain, then if you start withdrawing the gain, you will be taxed. So the way to get around that is to borrow against it. And that's why that's a strategy that people use with all types of assets. That's why Elon Musk didn't sell his Tesla stock because he's got a massive capital gain. And so he borrows against it and uses their money and lets his assets stay intact.
Are there different payment options that people could use?
Yeah, absolutely. And, there's flexibility from monthly to quarterly to annually. Annually is the preferred method. It's the cheapest, but over time, as you know, Richard, life doesn't always go in one direction. For good or bad, we can't control everything. So there is ways to change that flexibility along the way and even pause it if needed to, right? Imagine trying to pause your mortgage in your house. Well, banks don't always comply with that. They may not like that as much. So there is a lot of flexibility, and especially if you've built up cash, you can use some of your cash to pay your premiums as you sort of right the ship if there's things going on in your life, right? To then resume the contributions. So there's a lot of flexibility involved with these policies.
On a business side, on my side, I know it's possible, but I don't know. I'm just gonna ask. I think I know, but I'm just gonna ask anyways. On the business side, can small business and corporation use life insurance for building wealth?
Absolutely, absolutely. Because think about it, Richard. I mean, this is where if we think about it, and it's similar to just a different types of a banking function, right? A financing arm. Businesses, as you're getting, certainly as you're getting bigger, like the biggest thing they got to manage is cash flow, right? And management to pay the bills, to pay the overhead, the employees. And so where do a lot of people do that? They get it from banks, right? So this is another alternative to build wealth, store it, protect the owners too in the business at the same time, and leverage the financing arm to invest in the business, to pay for all the things you need for a cash flow. So savvy business owners use it all the time because it's very versatile and they can control it more than the banks, right? Banks have a lot of control of what we do, and we unfortunately have to play by their rules, right? This is a way to shift it a bit.
What are some tax advantages?
Oh, absolutely. So life insurance is great because obviously the death benefit will go income tax free, and um, depending on what you are, if your wealth is so high, and I know we have in the U.S. an estate tax. Like if you die with a lot of money, they take a chunk of that. Well, you can make that income tax free as well if you design it right and put them in trusts. But the buildup of cash is technically tax deferred, just like qualified plans. And I think in Canada, is it RSPs? Is that accurate? Like retirement accounts.
Yeah, RSP.
Yeah. Right. So it's gross tax deferred. And, we talked about earlier in this conversation ways to get that out tax free, right? By withdrawing the contribution and then borrowing against the gain. And then basically, when you pass, that income, that all the death benefit is tax free and can pay for any debts. So all along the way, you can benefit from tax advantages around it as long as you understand how to use it and are responsible on how to use it, which is the key. It's a really big key.
Any downsides of using that kind of product?
Yeah, so I think I kind of hinted on it. I mean, the discipline aspect is really important because people can unfortunately sort of lose sight of it, and just like any financing or leveraging of other people's money, if you're not careful, you can overextend yourself. And so you do need to have some discipline and be mindful of it and, grow into it. If you're not, then it probably isn't the best source for this, right? Because you can really easily sort of overextend yourself. And and if you're thinking about it from a very short-term perspective, it's probably not a good fit either because the life insurance policies themselves, the way they're designed, have a really long run view to them. And they get better at the longer you own it, right? It's almost like expensive to start, but very cheap on the other end. But if you're not thinking long term, then you're not going to get there, right? Just like any sort of thing. So if you're really thinking very short term, this is not the approach or strategy that makes any sense, right? It's just not going to work. You got to really have a long run strategy to it.
So when we talk about like saving, like putting money aside, is like when you get the policy, uh, let's say for 20 years or 30 years, whatever, how it's structured, what's the minimum amount you think that people should think about when it comes? Is it $100 a month, 200, or what is it?
Yeah, for me, I look at it, the dedicated sort of approach to saving money. You've heard some sort of the common refrain of, hey, you need to save, which I do think it's low, but say 10% or whatever it is of your income, you should be saving. I would hope, especially when you're younger, saving 20, 30%, because the more you could save there, then the more you can go invest it and build assets that can maybe replace your income, right, if needed, right? So, but if you use that as a benchmark to say, okay, there isn't any minimum amount, like what would I want to save from all the income that I generate? Just like the best book I ever read was Richest Man in Babylon, which I would encourage your listeners to read. Very simple book, but has a very basic understanding of we've got to save a portion of everything we make, right? Somewhere, whether it's in banks or life insurance, wherever, that's a piece of it. So using that as a good benchmark. So, to say that $100, I would say for me, a lot of it's just to getting started with it. Whatever you can save, then I would say at least a portion of it I would do here after you've kind of gotten some emergency money somewhere in, say, a bank account or something. Money that you don't, so then you don't have to go into credit card debt and sort of let go at the mercy of the banks. But I mean, to me, most of the people that I get started, I would say at least a couple $100, at least for a month to make it worthwhile. And then while you're building up your income elsewhere, you can grow into them. And we can design them flexibly so you can add more later. But it's hard to say like it's 100. I mean, to me, it's like how much would you want to save, right, for your future, right? And then we can carve off a little piece to put in here, depending on your situation.
What if your health is not perfect?
That's a really good question, Richard. And unfortunately, I come across it way too much. Um, so there are means where you can actually um, own a policy, but it's on somebody else. You can own it on a business partner. You can own it on your children, like someone who has some economic sort of connection to you. You can actually own a policy on their life as long as they comply, right? And if they're healthy. And so you can use that. And a lot of families have used this to build generational wealth this way. One main one, the Rockefeller family, everyone's probably heard of. It's a piece of what they do. But you can do it on other members of your family and you have better health and maybe you could, benefit, you could still own that policy and control it in that manner and take advantage of the benefits we've talked about. So you can own it in that way.
When the economy goes down, does it have an effect on the policies?
Well, so these are the ones we design. We've shifted the risk to the insurance company, right? So they're now responsible because it's basically a guaranteed contract. And I passed it around to a lawyer once and said, how do they call it guaranteed? Because they are on the hook to deliver on what they promised in this contract. And so they have to figure it out. Now, to say that they're primarily so they got two things working in there for them. One, it's a profitable business because they understand over large numbers how to manage this business because some of them have been in business for 150 years, protecting families in this way, right? And so they understand the business model. The second, and they don't take as much risk as banks, right? Because they have to pay on these death benefits. So the second piece of this is that they're investing in primarily fixed income, like bonds, mortgages, things that are government debt. So they're fairly safe overall, right? They're not taking as massive risks as banks because they know they have to make these payments. And so it's highly regulated. So yes, the economy could cause some damage to policies. However, their design of how they make money and how they preserve and invest is much, much more conservative than most institutions. So they're stable, and that's why they've been around through 150 plus years, some of these companies, through depressions to economic cycles, they've been able to prove they can withstand them way better than most institutions.
When we talk about the products, the whole life, are we talking also UL or just a whole life?
Yeah, so UL, those are for the types of policy we're using for the stable foundational pieces. We typically go with whole life because it shifts the risk to the life insurance company. Universal life, and you may have heard things like index universal life or variable. Basically, it's designed off of an annually renewable term insurance policy with a side fund, right, that invests in certain things. And so what it does is it offers a little more flexibility, but shifts the risk to the insured, you and me as the owners, right? And gives a little bit more flexibility to the insurance companies. And so for what we're using them for the foundational piece, we typically go with the whole life product because of the stability of it, right? And the risk shifting, right? For some folks in certain circumstances, it could work with universal life. However, what we've found over time is because it offered that level of flexibility, and this goes back to a very fundamental thing, Richard, what I share with people. Discipline sometimes is difficult for people, especially when it comes to finances. And I've unfortunately seen this way too much. When we offer a lot of flexibility on things, people get comfortable with that. And sometimes they won't fund these things, and then these things fall apart later down the road. Whole life does not work that way. It will not fall apart. You have to really do something to it to make it fall apart. It gets stronger as it gets older. Unfortunately, we're seeing with a lot of universal life policies because people maybe are not funding them appropriately, they fall apart later in life. They get more expensive as it ages. And then we're put into jeopardy. And sometimes, and I had this happen with my father, they put hundreds of thousands of dollars in this thing and they borrowed it and were not disciplined. And basically we had to give it up because we couldn't afford it anymore. And unfortunately, we do see that happen. So there could be cases it works. However, for what we sort of help position people for, we don't really use it for that purpose.
When we hear about infinite banking, it's the same for it relates to the whole life, right?
Correct, right. Some people use it on different ways, but yeah, it's we use a whole life sort of a chassis because it's just more secure. And if we're talking about foundational pieces, this is where infinite banking was born from. And so it just creates a much more stable foundation for allowing us to use it as a financing source, right? For anything we want for our spending and investment. So that's where it was born through Nelson Nash and becoming your own banker. And it's a foundational piece for, certainly my family's wealth. But it can be a really strong one for generational wealth too.
Which are the best companies out there for that?
Yeah, so there's a lot, in my world, there's a lot of they're really focused on the mutual insurance companies. And remember, those are the ones that, are not public companies. So, you have your large ones like Mass Mutual, Guardian, Northwestern, Penn Mutual. So there's probably a good 10 or so companies that are really supportive in this environment for mutual insurance companies, and you got to go with the highly rated. That's the only ones we use that are, highly rated, where they're assessed all the time around their strength as a company. You want to go with that because then you have the highest chance of them going to be around when you need that money, right? And so we have to go with the ones that are larger ones, like those, and there's probably 10 or so that are really in that boat.
Where can people learn more about you and follow you on social media?
Yeah, so I have my own podcast called the Perennial Pride podcast. Certainly follow there. I have great guests and information talking about alternative investments and different ways to build wealth. And I'm certainly on Facebook and YouTube, and so I try to share as much content just to spread the information around education to empower folks to control their own financial lives.